Here we are looking at the markets after the US election. The question is, how far can they rally, and what can history tell us about when this has happened in the past? While we're also looking at history, we want to know which sectors have performed the best. We've seen Trump come into US presidency once before. Can that playbook replay for us, and how is that currently unfolding? The final one is, are there setups within the market that we can really be looking at and zeroing in for the next opportunities? Gary Glover's done the homework and he's here to share us with his weekly report. Good morning, Gary. How are you?
Oh, good, Chris.
I like this week's report. You've got a bit to cover. And just before we were recording, you were saying you were a bit excited about some of the levels on the US indices. So just on screen here, we're scrolling through that's the portfolio with some of the positions. It can definitely pause that to have a look in a bit more detail. But this chart here, quite an explosive movement on the NASDAQ with the US elections. So when you're looking at this chart, this market, what pops out to you?
Yeah, some big levels actually for all of the major indices there. So I think 20,000 there for the NASDAQ, 45,000 for the Dow, maybe something like 6150 for the S&P 500. So just some big levels ahead here. So it's pretty interesting there because they're all sort of like key sort of Fibonacci levels, and they're also like, I think two of them are like 100% squaring of previous ranges as well. So like if say a stock was sort of caught between say $10 and $15, $5 range, and it expands another $5, that's a big level when it expands that same amount on there. So the NASDAQ has sort of expanded that 61.8 level. And I think where the S&P has expanded 200% of the range, I think the Dow sort of something similar. So there's just some big technical levels on all these markets just ahead here. So it's pretty interesting. I've seen this a couple of times in the past there. So two things can happen here is that is you can go straight to the target pretty quickly, and then that can be and then you get some big resistance there, and then pull back there. Sometimes they can pull up just short of the of those sort of all those sort of key levels, pull back and have a little bit of a I guess a little release. So you might get maybe a 5 or 7% pullback just shy of those highs, and then you go back and do a retest and go to a margin high and then hit all the targets in. So a few times I've seen these big targets there that they're going to get there, and then they pull back. Oh, they're not going to just before you think just as they get close, which sort of will surprise the market. And then it goes back and actually retests another margin new high, which you think about like a lot of highs, they will have that pullback all the time before the high, and then just make a margin new high to sort of finish the move off. So, so just sort of something to be mindful of here. So we've had the Trump trade, obviously we've had, move high here. So I think we're going to keep edging high here, probably more of a grind because we've had that really sharp jump here, out of the election, and it'll probably grind a bit high here over the next week or two. But yeah, it's funny. I'm really mindful of so far that the 60-year cycle has been pretty similar. So I think the 60-year cycle is just something sort of strange here. I think it topped around the 20th of November, pulled back to the 15th of December. So I had like a 5 or 6% pullback, nothing too big, just standard sort of pullback in an election year. But it was a little three-wave sort of, I guess there were like a release valve on the market, and then the market went higher later on into the year. So that can happen. So that's just sort of something I'm mindful of, just because we are approaching this level. Just it's like watching a sort of a typical movie plot. Sort of it's because everyone's getting pretty. You must admit, everyone's getting pretty complacent. It's sort of it's been good news. Market's been rolling on for a while here. Probably the best conditions we've seen for a while. The president there is going to do tax cuts. We've had interest rate cuts with inflation under control. Probably, the environment's probably the best environment we've had here. So, markets climb the wall of worry. Have all the worries started to disappear? That's if they have, we should be starting to get worried. It's because if all those worries are no longer there, then that's when usually markets can find a high here. So just something to be mindful of. I think we're close, go slightly higher here, but just got to be cautious of, the fact that markets, it feels like there's a level of complacency there now. No, we haven't seen for a long, long time. So just make me a little bit guarded.
So that's, well, obviously all three indices on the US where we've got that complacency kicking in because we've had the US election unfold and it's a lot less to be worried about. The technical levels that you've got on the S&P 500, so we're looking at that chart here, just highlight the range here. So from the high down to the low, if that becomes 100% of the range, then what you've marked here is 100% extension beyond the previous high. So the same distance it pulled back here, adding that to the breakout, and we're getting awfully close to that, aren't we?
Yeah, 100%, Chris. That's bang on. So, and as we saw a really strong resistance at the 161.8 previously as well. We had a really good reaction there, and then another bounce, and another reaction as well. So it is, sounds funny here that this market is respecting a lot of the fibs. I saw on the way up here, the market pulled back to the 50% of the range. Had a few touches on the way up there, pulled back to the 50. In October 23. So the fibs, fibs have been working quite nicely there. So so definitely got to respect it. I think if we get to around 61.40, I'd be definitely, like that US exposure, I'd be lightning off there for sure. Just not euphoric at the moment there, but it just does worry me there that everyone's sort of now is the market has sort of climbed a wall of worry here. There's been a lot of negativity out there, a lot of negative things happening, and then the market's just sort of kept ticking along. So just starting to get nervous here that all the worries are now possibly behind us there. And that is the biggest worry. So it sounds funny saying that, but that's just the reality of how markets work. So I think we get a little bit, another 2 or 3% higher here. Probably, I'll probably definitely be maybe looking to scale back a little bit, take something out the top here.
Right. So a bit of taking chips off the table, putting the cash in the bank, keeping some powder dry. S&P 200, the Aussie, the ASX, top 200, the XJO. We haven't had that same surge. Obviously, we didn't have the election. Ours is coming out sometime near May. But we still have been grinding higher. So looking at the 60-year cycle, which is obviously the S&P 500 and the US, we've got our own market, our own cycles. And as you've said, we've got different fib levels that we often adhere to. How do you take what's happening in the US and what can possibly happen to flow into the Aussie market?
Yeah, I mean, look, it has been a bit of a grind there for our market. I guess the healthiest thing that we've seen in our market, and we've commented this for a while, is that we've definitely seen rotation throughout the year. So we haven't seen all sectors running together. We've definitely seen some sectors, get under pressure, and some sectors have been under extreme pressure while the market's been moving higher here. So that is sort of a good sign there. We're just seeing, we saw uranium run hot earlier in the year. They had a fairly large correction. Like a lot of the stocks come off 50%, Chris. We're just starting to see gold come off here in the last couple of weeks here after having a pretty, momentum orientated sort of, quite a large run there for a lot of those sort of for that sector there. So everyone's probably looking to sort of tip back into those golds pretty quickly here. But, if that uranium move, how pronounced that was and how major, big a move that was, and the correction that followed, that should be a bit of a guide as to what could happen to gold as well. So I'll be wary about rushing straight back into gold here. You can get, like a lot of those uranium stocks came back 50%, Chris. So very large pullback. So I'll just say, this is it's definitely seen a lot of V-shaped moves here up and down here in the market. So markets tend to be sort of overshooting both ways here. So I'll just be careful of that. I'll just be looking for opportunities there. I mean,
you had mentioned looking at the Aussie market and into the next layer of the sectors. Just before we drill into the sectors, it was an interesting report looking at the top 30 companies in the ASX over the last year. Obviously, we had a decent rally throughout the last 2 months of last year, which helped push it on for an average of 18%. But there were not many companies that sat in the midline around 18%. There are some top 30 companies with over 100% returns, like the Pro Medicuses of the world. Telstra was about 4% negative. But then, as you said, the mining companies that we'll get to in a second, they'd actually been quite opposite. So that rotation that you talked about, they've been sort of hammered and dragged down the averages. So just on the Trump trade that we saw before and where we sit today, do you see much opportunity in the financials, energies and materials within the Aussie market, just from a sector level?
Yeah, it's like last time, obviously, Trump was in office there. Those are the three strongest sectors. So just wondering whether we see that, moving forward here or not. So to me, I know financials are pretty robust there, but look, they look pretty extended here, to be honest there. So pretty well priced. So it's not to say that they can't go higher. We've like a lot of these financials have sort of have exceeded most people's expectations there. Like most analysts don't have valuations where they're at the moment. They've got quite a bit higher here. Yeah.
A few still recommendations on.
Well, we got banks on PEs of sort of like 17 to 22 times earnings, and yet they've got flat revenue and actually negative or flat earnings. So that's almost unheard of, Chris. That's pretty rare. It hasn't been a long time since I've seen anything like that. So, and the one thing that you saw actually in that NAB report there recently was that some bad debts are sort of starting to. Delinquency is sort of starting to creep in there as well. So that's, Jesus.
Rapid rise for the quarter, wasn't there?
Yeah, so you're starting to see some, yet. So no earnings growth, negative earnings growth, still trading on 17, 18 times here. So, that's sort of, that's a risk, that's not a risk I'm prepared to take here. Having been involved in markets for 20 plus years, probably showing my age, but, you just don't normally see them trade at those high multiples. And they're not, these businesses aren't, we go back sort of 15 years ago, they were going into managed funds, and that was probably a time where there were, there's a little bit of growth coming through in those businesses. So even in those periods there where they had much better, revenue and earnings growth, they weren't trading on these multiples, even though they had greater growth then. So now we've got no growth, almost negative earnings growth, and they're trading on way beyond the novel multiples there. So, but look, the only thing I'll put that down to is that in the past, there's high inflation periods in the past there, we have seen some of those value shares trade pretty well throughout the period, and that's because they've been in a high inflation environment, people want to get paid. So the dividend yield becomes more important. So maybe you overpay for that certainty of yield, and the banks are just going to tickle on. Yeah, they're going to have some negative years a little bit, but the returns are going to be pretty in a pretty bland sort of window, But you've still got increased competition. You got so many. You got AMP, Macquarie making inroads there. You got Judo. There's all the small lenders making some inroads. So yeah, it's
competition ahead.
Yeah, when the market turns here, when the market does get into stops going up. That's a sector I'd be pretty wary of there because, Well,
we'll look at the materials and energy in a second. Just last one of the indices to look at, the Dow Jones, mostly from the expansion level. You obviously talked about the economics, what's happening in the US, the Trump trade, and so on. This range, the high, the low, if we extend that length, that number of index points, and then push that onto the breakout zone, we're coming up towards that 45072. Yeah. So can we get to 45,000 on the Dow Jones? Or is it the similar sort of thing?
Yeah, probably easily. If you look at that three ascending trend lines there, the fact that the trend's actually accelerating, not 45,000 might be selling this short. I've seen when trends like this get going here, can move higher there. Just interesting, Chris. I sort of I think I read something else. I think it might have been South Korea or something. They're sort of I think they were talking about having about 10% of their holdings in US based shares and stuff. They're like the top tier and stuff there. So just talking about, and that's sort of one of the things that is driving some of this. Some of these other markets haven't been as bullish as the US, but that's probably because the result of if we go back 5, 10, 20 years ago, it was much harder to invest overseas, whereas now we've sort of got access to a lot more markets there. So everyone's going to the strongest market, which happens to be the US markets at the moment, some of these US companies. So this means not only are US investors invested in those top names, then the rest of the world is invested in those top names. So everyone's sort of getting pointy in that, US, and then that's sort of causing this, this move here. It's quite rare here. Also, the drive of, the popularity of ETFs, where you just keep buying the same amount of shares. Sort of like a lot of the ETFs were pretty popular after this last pullback there. And coming out of the election now, I just noticed a lot of people were piling into the bullish ETFs as well. We saw, there was a double Tesla. Like the Trump trade there, we're talking about some of the sort of stocks in there, some of the crypto ETFs, some of the double Tesla ETFs. I mean, there's just all these different ETFs that they're piling into. So that's kind of fueling some of this momentum. So there's no reason why this can't get a bit more, like it looks like it's accelerating going into a life there. This is what McLaren would say. There's three ascending trend lines can get an acceleration and into a bit of a vertical top here. So I guess don't underestimate what this can do here. How this could go a bit further than everyone thinks. So there's some big levels there technically, but this trend is winding up. It's not slowing down, Chris.
That's definitely those three ascending trend lines that you're talking about, and you've looked at that and studied that many times before, including in the Chinese indices where we've seen some blow-off tops come in. So probably time now to drill down into that level. You did talk about financials, energy, and resources that have benefited during the Trump trade, and you've also talked about the high inflation period, which the RBA is coming out and saying, well, it's higher for longer. So we've got those two macro overlays happening at the moment. Mineral resources is on the front page of newspapers for not the best reasons.
Yeah.
It seemed to be old news, but it's sort of rehashed and surfaced. It was something that happened in the past. They came to settlements with the ATO, but it's not good from a corporate governance perspective. And we've talked about how the impacts can impact from investors like super funds not wanting to be around this. What's critical about this part of the chart and what's been happening here?
Yeah, probably the critical aspect is all the noise there, Chris. So, and like I guess, you're looking for maybe, at the end of the day, we've got a pretty strong business here. It's been pretty strong, had very strong growth here, for many years. And I know like a lot of analysts sort of view the crushing business within mineral resource. It's only one segment there. Like a lot of them sort of value that around $44, $45, just that part of the business alone, let alone their lithium and iron ore. So, obviously lithium and iron ore being a bit weak here. So put no value on there. You've sort of still got a reasonable business in there. And then if lithium does turn here, then you get some upside there. Obviously an iron ore does turn as well. You've got some upside as well. So, what's the worst case scenario is that, it all gets moved along and maybe this thing gets broken up. If this thing gets broken up into lots of parts here, probably, the one thing you learn about when they break businesses up is that the sum is usually worth more than the sum of the parts, usually worth more than the whole entity here. So that's probably the worst case scenario I sort of see. I just think that sort of the CEO is probably in the sin bin here for a while. So probably, take a bit of a back step here. I think it seems like all the data, all the information is out of the public domain here. So, I just look at the chart here. Really, it's come off pretty hard here on the back of the last news. And there was a lot of short covering too in that position. A lot of people obviously knew something's going on here, shorted that there. Then we had a massive short cover rally, big bounce there, sort of once that China sort of stimulus sort of came out there. And then we had a lot more bad news trying to, come out to try and bring this price back down again. And since then, you've actually seen the short covering reduce quite a bit. So the level of shorts actually has gone from being pretty heavy to actually a lot less. So that means like a lot of the shorts are now getting out of here, sort of like it's almost out in the domain here. So
they've taken their profit and they move on to the next trade.
Yeah. And you've seen here, it's like rallied 4 weeks and now it's pulled back 4 weeks and it hasn't taken the low out. That's a good sign there because obviously this has been a pretty aggressive downtrend. And you're seeing big volume here, Chris, as well. So you got to ask yourself, when you see the big volume, is this accumulation or is this distribution? And the fact that we're down, we're not seeing this near the highs, we're seeing these down near the lows. It's a good sign of accumulation there. I do like the fact that weekly range there, so from the early 23 high down to the early 24, that range there from what now 96 down to 52 or something there, that expanded 50% of that range to the low. That's again a nice big Fibonacci sort of, so it's gone sort of 50% of that range to find that low right bang on. So good technicals, then we go back and retest the break zone where it broke through, and then we sort of come back down again here. So just some really good technical sort of signs there. So yeah, it's sort of one that I sort of view as there's a good business there. End of the day, have we had a correction because something in the business has changed, or just because something a big exterior? So you can say, this guy, the CEO has driven this business, and maybe it might be the same without him. But it is to say, business can't kick on and do pretty well. And it's just sometimes these external factors can cause, and I find those external factors can be the greatest opportunities as well. So like ResMed there, your business just ran along. The Ozempic caused a lot of noise and caused big sell down in the stock. But you look back, look forward a year or two later, it's still selling sleeping apparatus. It hasn't changed too much. If anything, actually, the Ozempic's actually brought sleeping more to the fore. And I mean, I think all the health experts have been moving towards sleep being more important anyway in the last 5-10 years. So if anything, it sort of helped ResMed as well. So that was an external factor, not an internal. So nothing changed within the company itself here. So here, nothing's changed from Mineral Resources, the actual company itself. It's just we've got a leader in there who's been a bit naughty and not left his tax bill a bit late. And yeah, so you just got a few little issues in there.
Right. Well, we'll see that unfold, and probably a bit of leadership change, a bit of activism coming from the super funds or the future fund. We'll yet to see. Another company that we've looked at a few times before. You've looked at this from the perspective that there could be an opportunity like what we've seen with China in the past, where they need to stimulate their economy that can really stoke the fire for China's economy, stoking the fire for resources. For the New Zealand economy, we can look at Australian listed companies with businesses in New Zealand. Clearly, Spark fits in that camp. This is a terrible slippery slope. Like, if this is a slide, I'd be quite scared of it if I was at a theme park. That's pretty hard and fast. But you were just talking about there's a lot of volume here. Is this at the top or at the bottom? Well,
yeah, no, you're right. So super aggressive sell-off there. I mean, that's a massive decline, literally halved in value. If you actually look at the 2010 to 24, so like a 14-year range, they actually come back 61.8 that range, and that's a massive correction for an industrial, particularly one sort of it's probably a bit sleepy, like as an almost like an infrastructure type of sort of play as well. So they had a fairly large decline for an industrial company, sort of almost an infrastructure asset there. So
with very consistent and regular revenues, right? Less revenues, very regular.
There's massive decline there. The interesting thing on the chart there, Chris, is apart from that 61.8 on the long-term chart, is that first decline went 26 weeks from sort of high to high, which is half a year cycle. And then it's got another 13 weeks into the low, which is a quarter year. So it's sort of done a half year high to high, then another quarter year high to low. So we've got some good timing there for a lot of lows. So I know sometimes when we're like a lot of market tops will come in with a quarter year, but the last rally will be like a last quarter year rally to finish the move off. So we'll see we might have a bull run, then we'll have a little bit of a pause, and then the last rally will go up 3 months just to finish the move off from a bit of a swing, from a swing low there. So just you can get the same thing for lows here. So we've got some good technical levels, we've got some good timing, and the price action, the volume there is showing some pretty decent.
A lot of changeover.
Yeah. So looks pretty interesting there, really. So I think it's I really like this one here. I think we've now got the yield locked in there for next year, sort of confirmed the 25-cent dividend. So
do I ask you how that compares to the big four banks? The yield on for 2025 Sparks have a yield like that. That's massive in the current context of us chasing yield in the high inflation environment. You talked about Big Four banks of Australia's nothing in comparison to this right now, isn't it?
Yeah, no, it's a pretty good yield there. So it's yeah, I mean, obviously that as those banks have gotten higher and higher, it's gotten skinnier. Yeah, but yeah, no, look, I think I look at obviously these, any of these yields and a lot of these stocks, they're not sustainable if they can't make earnings and stuff there. But I think with Spark there, the revenue line was, I think, it was only off maybe 1% or something there, and like the earnings were off, just a little bit more. And that they really haven't, they weren't able to really pass on too many of the, inflationary pressure sort of costs that they'd endured there. And that's, I think part of that to do with the New Zealand economy just being so weak as well. So having rates at 5.5% for a couple of years there, it's sort of taken its toll. And if you look at all the data that's coming through most of the New Zealand firms there, it's sort of pretty weak. You just saw NHF today come out and actually, I think of their, so they gave the 250 mil guidance for the year, but they're going to take a $10 million loss in the New Zealand business there just because that's been weak. But they're talking about a bounce back in 25 for New Zealand. So, but that's sort of similar tale across the tape there for everyone.
All right. Well, going into the materials that you talked about before, you had alluded to, we talked about Fortescue recently and this VCP that was forming in here. It's a nice tight, but it's triangle VCP. It did break out, but what's happened this week, not quite on the chart, because obviously you do these reports on the weekends and share them with your clients on a Monday. What's caught your eye on this chart and what's important with Fortescue?
Yeah, so I thought it was a pretty good setup here, Chris, because it sort of had a pretty impulsive move, pretty good volume on that move. And then we've had a bit of a pullback and the whole thing sort of tightened up just above the 50 moving average as well. So I thought this looked pretty good there, but did sort of break out there on Friday, but then come back in the range. So I was telling you sort of earlier, I remember a few rectangles over the years where they sort of break out. Rectangles are like one of the lowest failure rate patterns there. So I think only, maybe like a 3% failure rate. So these high probability patterns, when they do fail, it can be quite negative. So getting out and failing, and particularly with a bit of volume as well. So it has sort of come back last couple of days there. So look, I might hold here maybe around the 61.8. Probably needs to hold around $18 there. So, but yeah, probably to me, I'll probably leave it alone there. I prefer to sort of see them hold, stay tight there, and don't have too much short there. So the fact that it went lower there yesterday is a bit negative for me. So I'll just probably sit back and watch, see if it can't sort of recover here.
All right. Well, another one in the similar space, Rio Tinto. And we've got this rally that you just talked about. We saw with Fortescue, good volume on the way up, rallied exceptionally high, hard and fast. You got the 0 and 100 here showing us that total range. And then one contraction, two contraction, third contraction, getting smaller, and then popped up just above that swing high. What's happening now? What's this volume tell us? And is it another 61.8 that's on your radar?
Yeah, sort of similar setup there. We sort of had some good volume that rally, each pullback got tighter and tighter. So that's pretty good sign there. Even the volumes, even that last little pullback there too, Chris, as well. So this is, I view this as a good setup here. Just one that's failed here. This is obviously why he stops them. I didn't trade this one personally, but I think this was a pretty good setup here. So whole thing tightened up here and looked like it broke up here on Friday there. But it has pulled back there. I think it's actually held up better than the other stocks. So it's held up probably a little stronger, but still sort of negative. When you sort of get a pretty good setup there and then it breaks there, it can be negative as well. So, view is slightly negative there, the fact that it has gone through there.
Shifting gears into another segment of the market economy, Data 3, DTL being the ticker, very different chart. We had this phenomenal rally. We are looking at the weekly chart here, massive rally, and then a very rapid fall. And this is something that you've looked at significantly particularly in this market, undercutting the lows. So I'll just highlight it to save you. Is this low here and this low here? Why is undercutting the low important, and what is DTL doing for you?
Yeah, I like to see them in the top half. So sometimes you look at a daily chart there, it might seem down the bottom there, but look at the longer term picture there, you can sort of still see it's still on the sort of upper quadrant here. So definitely had a little 3-1 down. I mean, we did get an undercut there last time and had a bit of a bounce out of that one. Didn't quite go to a new high, but now we've come back and retested that low there. So the only negative of this one, Chris, it is a little loose. So not sort of tight here, even though it has tightened up here at the low. The volume is a little heavier than you'd like to see there. But don't rule it out there, because I've sort of a few times I have seen this sort of heavier volume down in the past, and then it can turn there. As long as we sort of see good volume come in on the turn here. But yeah, so I think this is interesting there, because obviously this is that sort of technology sort of sector there. So like a lot of the tech stocks have been pretty robust there. So I noticed like last time, a lot of the tech had a run there, and then we sort of few of the tech stocks lagged there. Actually, one was like Dicker Data there. Like everything had run without it. It was sort of like it was previous year's leader, but it never got involved in that sort of 22, 23 rally. But then it eventually did have a run later on. So it's interesting here, like, see 360 technology, T&E and Zero. So a lot of those other tech stocks have been running pretty hot here. So so I know it's maybe slightly different there, and in that sort of data sort of IT sort of service provider and cloud services there, but still sort of in that technology space there. So a bit of a surprise it's down here, but yeah, we've just seen some good moves come out of these undercuts there, and definitely in a market which is pretty volatile. Probably seeing a lot of V-shaped highs and lows as well. So this is probably a better setup here, just seeing a marginal new low there. Only go lower for maybe a day or two and then come back with a range there. I guess that the beauty here is, Chris, if you do take a position there near the low, then your risk is pretty low. If you're wrong, you're going to find out straight away. If it does rally here, then it could be some upside potential. So that's the beauty of that sort of setup there. We have seen, I think, car sales, I think, TLX, the Orica here recently, just some of those stronger names have actually done a lot of these pull back in 3 waves, undercut the low, and then had a nice rally. I think even News Corp was recently did the same. It had a pretty nice rally here, so it can be a good sort of technical setup there.
Well, you mentioned Dicker Data before. We've got the chart here in your week's report. Notably different, still the weekly, but we're looking at the bottom half of the chart from this scenario here. We've got the fib levels here, these light pink lines showing us from the lows, a bit busy in here, from the lows up to the high. And then we've had the retracement, which is surpassed the 50% level. So come down under it, go back over it, and then where we are now, surpassed the 61.8. However, we've got these two lows once more. We're undercutting them. And if we look at the time period, well, obviously today, but April, May, similar sort of thing, April, May. So that importance of the sectors that you talk about. So what's happening on the chart, and what's the key levels for you to look for?
Yeah, there's a fair amount of time there actually between the lows as well. So it's taken a long time to come back and retest that low. So that's actually probably a good sign that it's. If you remember that last one there, sort of we had the lows sort of early 23, and then it ground, really basically went sideways for quite a long period of time, undercut the low up quite a few months later, and then recovered then. So that can be a good sign there, the fact that it's sort of struggled to go down there and then come out. So yeah, it seems like a bit of a laggard here. I know sometimes we prefer to trade, we prefer to sort of stick with the leaders there, but we have seen it, that Dicker Data did come out last time at a time where everything else had probably already run. It was sort of left behind. So other stocks can come to the play there at times there. So there's probably two that I think look pretty interesting there, just because they should be. They're in sectors there where they've been pretty robust there, but they've been going down here, sort of against the trend here. So, but both those stocks are probably yesteryear leaders. So, and as we know, so like the leading companies, one bull market aren't going to be the next leaders of the next bull market. That's pretty rare. You can get some, can be, but pretty rare. There's normally new leaderships emerge here, but not to say we still can't get decent moves there for those two. So I think those are pretty interesting there. And it's not a little volume there, Chris, not exactly too much. Yeah, so it's not, you're seeing a little bit of volume at the lows, but you haven't really seen any aggressive sort of selling from those as well. Been pretty light all the way down. So, I think it looks interesting here, actually. Yeah.
Moving into another part of the market, corporate travel. This is one that you looked at a lot during COVID, capital raise in that whole travel space and how they positioned themselves. 0, 1, 2, 3, we'd love to see that. 0 lows, 1 low, 2 low, 3rd low, and that's what it's been trawling higher. We do have the daily chart here just for a little bit of change of pace compared to the other charts we've just looked at. So these here are showing, since the last time we looked at it, is that really setting in place? Is that enough for a 3rd low? Can we tick that box yet?
Yeah, I mean, they were doing a lot of displacement work in Europe there, obviously, with all the wars and stuff, raging on. So basically, rehashing trouble moving around. Yeah, so look, they did pretty well, but that's all sort of come to an end. Sort of a bit of a policy change and that. So almost a bit like COVID for the healthcare. It's sort of like, was feeling some returns there that stopped, and then you sort of go back to your core. So even though it's only a small part of the business there, was sort of quite fruitful at the time, but as a result of that, the stock's now gone through a fairly large decline here. The last update was pretty positive there, so the rest of the business is still coming along pretty well. The corporate sector has actually, probably been more robust than the retail segment as well. So, so some good signs there for corporate travel. So I think, this is, definitely not on a demanding PE and considering this company's sort of growth in the past there. So I like the fact we are sort of starting to build a bit of a base here, sort of pretty solid. Starting to see some good volume coming at those lighters. So everyone sort of thinks now we might see Trump in there, we might see maybe less conflict around internationally. That might be good for travel as well. So, I think the fundamentals look like they're improving there for corporate travel, and I think that maybe the external factors are improving as well. So, it's been a great business in the past, been pretty well managed. The only travel company not to have to raise money through COVID. I do rate this company pretty highly. So I think this is one here. I think if we sort of see any pullback, any little tight congestion there, this is probably one that I'm probably going to try and look to add to at some point soon.
Well, taking the extension of looking at Trump and what happens with global markets, looking to North America for a bit of direction, Deterra Royalties is a bit of an odd one on the Australian market. It is something that is extremely popular, particularly in the commodity markets of Canada. We do see a lot of the royalty trusts listed over there. This is a rare one for the Australian markets. As you've written in your report, commodity royalties mixed iron ore and lithium prices. So quite often they're seen as a bit of a proxy into it, where you have less of the downside of the inflationary costs, labour costs, and that kind of thing. You just have the commodity itself. So DDR, a rare one on the Aussie market, but quite popular in Northern America, that type of structure. What's caught your eye with this on the chart?
Well, it's quite interesting, because I think, the PE is sort of how under 12 there, and the yield's over 8%. So that's pretty interesting there. And they are reasonably diverse there. They've got some lithium and some iron ore, which have been a bit negative there, but they also have, a bit of exposure to quite a few different areas there. I did sort of see that they were pretty heavily into gold as well. So, but I guess just diverse sort of royalties coming in across the board here. But just sort of think this one's pretty interesting there. Just because it did have a nice bounce out of that China sort of stimulus sort of rally, and it has pulled back here. Just come back a little deeper than maybe some of the other material stocks there. But the volumes have been pretty light here so far. So just watching this one, maybe it'll come back sort of under 360. Back to that 61.8 there, but that's a level to sort of keep an eye on. We're just going to watch this one here. I like the fact that we had a nice rally there, broke above a couple of swing highs on the way down as well. So this has trended down for quite a while. So me personally, I want to see a bit of a change in character. I want to see it break above a couple of previous swing highs, which we've sort of done there. And I think early August and late August there, and two little swing highs we've gone above those. So that's a good sign there. Want to see an impulsive rally, and I want to sort of see it struggle to go down here. So it's come back a little deep so far, but not too bad here. So resources typically do have a habit of coming back. Like a lot of industrials only come back half the range, whereas a lot of the miners will come back maybe 3/4 or 2/3 of the range as well. So they do typically deeper pullbacks, because they do tend to move a bit faster as well here. So definitely watching this one closely there. Some value there at the moment. Interesting business, the royalties there. So even though the share price has had a fair decline there, but I think that's to do with higher metals going up as well.
Definitely, it's reflecting what's happening in commodity markets, that's for sure. And this week's report, you've got a whole mix. So you've got markets, the indices and what's happening in the outlook there, the sectors to understand, and then looking down where the value is. At that point, we say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
Gary's talked about these leading companies and what he's looking at from the portfolio perspective. On Fridays, he also looks at the momentum leaders and picks out the best opportunities there. You can click on the link on screen to see that video.